Hello, everyone. Can you hear me? Are you there? If you can hear me, jump into the questions section. Let me know you hear me. All right, there we are. Great. All right, perfect. Well, let's get started. Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper, and I am a hard money lender and full-time real estate investor. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. I want to thank everyone for making it to tonight's event. We know that you're giving up some of your time, so Megan and I will do everything we can to bring you the value that you're hoping for. This webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors. We are investors ourselves, and we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. If you're in Minnesota this coming weekend, Saturday, November 10th will be our Real Estate Investor Success Summit. This is the premier real estate investor event in Minnesota. We're expecting between 100 and 150 attendees. We'll have 8 local expert and investor speakers, 15 vendors and an expert panel, and of course, the networking happy hour at the end of the day. Best part, there will be absolutely 0 sales pitches. If you've not yet registered, please go to www.mniss.com to register. Again, that's www.mn like Minnesota and ISS like Investor Success Summit, mniss.com. Tonight's webinar brings in a longtime friend, Megan Quintana. Megan is a senior business development manager and has been with New Direction Trust Company for 2.5 years. She attended the University of Idaho and moved to Colorado post-graduation and found a happy home with New Direction. Having worked within a few different departments has allowed Megan to better serve clients by being able to discuss the full lifetime of an account and what you can expect as a self-directed investor. Megan, can you go ahead and tell us a little bit about yourself before we dive into tonight's presentation?
Thanks, Justin, for the introduction. As Justin mentioned, my name is Megan Quintana, originally born and raised in Idaho and moved out to Colorado back in 2015. I grew up in a family full of IRA individuals. Both of my parents worked for Edward Jones, so post-graduation, I knew I wanted to get involved with retirement accounts, but wanted to differ a little bit from the family industry, so thought the self-directed route would be a lot more fun than typical stocks, bonds, and mutual funds. But that's a bit about me. Love Colorado, love living out here. And just a preface as well, if any of you are going to the Minnesota event this weekend, one of my colleagues will also be in attendance at that event. So if you do have additional questions following this seminar, feel free to ask throughout the seminar, ask him at the Minnesota event, or I'll give you our contact information at the end of the event if you do want to follow up directly. And Justin will be relaying questions to me, so feel free to input any questions throughout the presentation and we'll answer them as we go. And thanks again for joining us.
That's a great point, Megan. So we're going to be using the questions section. I know there's also a chat box. I will not be keeping my eyes on the chat box. So definitely jump into the questions like you guys were when I was first jumping in, making sure you could hear us. Use the questions and ask away, okay? We're here to make sure that everybody leaves with a good understanding of it. So definitely don't hesitate to jump in with your questions.
Thanks, Justin. All right, to get us started today, we kind of wanted to discuss the differences in account types because not all accounts are created equal. Many people either don't know the differences between all of them or don't know whether or not they're eligible. And I will say a lot of the time it depends on your employment status as well as if you're moving money from an existing account, what type of account that is. So we'll cover all of that in detail today, differences between individual and employer accounts, and how they can be used to be self-directed into any different type of real estate venture. To get you started today, though, we do, of course, unfortunately have to always start with this disclaimer of New Direction is not here to provide you investment advice or endorse any specific type of products. We are not fiduciaries, so we can't tell you where to invest your money, unfortunately, but all of this information is for educational purposes only. We hope you put it to good use. and highly encourage you to consult with your financial team, whether that's CPAs, accountants, financial advisors, even family and friends. Always get their input before you venture into any new type of deal. So some of the types of accounts that we're going to be discussing today are both employer accounts and individual accounts, as I had mentioned previously. Those employer accounts are your simple IRAs, SEP IRAs, 401ks, and your individual accounts are traditionals, Roths, and HSAs. The HSAs weren't really covered as much in our description of this seminar, so I'll try and keep those fairly brief, but they are a very cool account type in terms of the resources that they provide you. They're kind of a combination of the best of both worlds in between traditionals and Roths, and they can also be used for self-direction. To preface this, I want to make a distinction between pre-tax and post-tax accounts, because that's oftentimes the starting place of any conversation of which account type do I choose. So all of your employer accounts, as well as your traditional IRA, are considered pre-tax accounts, meaning that when you put money into them, you take a deduction on your personal income tax, they grow tax deferred, and you will not be taxed on them until you pull any of the cash out. Usually that's after 59.5, because after 59.5, the 10% penalty is no longer applicable. Your post-tax accounts, like your Roth IRA, are where you can put the money in, you do not take a deduction at that point in time, and the money continues to grow, tax deferred. The difference being that when you take the money out, you do not have to pay tax on any of that cash that you take out. Again, that 59.5 threshold is in place as well for the Roth IRA. The HSA is a bit of the best of both worlds, because HSAs are meant only for expenses related to your health, so your doctor's bills, prescriptions, etc. But when you put money into an HSA, you take the deduction. But when you take money out at any age, assuming it's being put towards a medical expense, it comes out tax-free. So you get the best of both worlds with pre and post-tax for HSAs, but again, they are only meant for medical expenses. Now, to move on, the big question is always, how much can I put into these on an annual basis? Can I go sell my house and have all of this money from my sales proceeds and put them into an account so that I can avoid some tax and kind of counter the capital gains tax if you were to purchase it with personal money? For your traditional and Roth IRAs, your annual contribution limits, if you're under the age of 50, is $5,500 on an annual basis. If you're over the age of 50, you get an extra $1,000 for a catch-up contribution. Things to note with the traditional and the Roth, that contribution limit actually covers both for any and all accounts you have out in the world. So if you have a traditional at Fidelity and a Roth at Edward Jones that you want to make contributions towards each year, you can split that contribution in whatever manner you'd like, but that $5,500 or $6,500 is your absolute max that you can put in between the combination of all. Your HSAs are dependent on whether or not they are a family or an individual plan, meaning whether or not your health insurance covers dependents and or spouses. For individual accounts, for 2018 contribution limit, that $3,450, $1,000 catch up if you're over 50, $6,900 if family, additional $1,000 if you're over 50 as well. Your simple IRAs are where you're going to start seeing the increases in your annual contributions, because you're starting to venture into your employer accounts. So for a simple IRA for 2018, you can put in up to $12,500 plus $3,000 if you're over 50. So putting your full max if you're over 50 years of age at $15,500. Your SEP IRA is $55,000 per year, but there is no catch-up contribution for SEP IRAs because these are entirely made by employers. The contributions are. There is no employee portion of it. And your 401k is a mix of both employer and employee contribution, and I'll get to that on the next slide. But this is the account with the most eligibility for a higher contribution. So for 401ks for 2018, contribution limit is $55,000 plus $6,000 extra catch-up contribution if you are over 50 years of age. And I'll break down a little bit as to how those are calculated so you can get a better sense. That's not always the absolute amount that you can put into a SEP or a solo 401k. It is often dependent upon revenue generated by the company and or the salary that you take on an annual basis. But that is the absolute max that you can put in. It might likely be lesser depending on how it's calculated. Additional things to note: multiple like-kind accounts, meaning both pre-tax, does not mean you get an increase in your annual contribution limits. Oftentimes people call me and say, well, I can't make a contribution to my traditional IRA because I've got a company sponsored 401k and I'm putting the max into that. Those are different because those are employer versus individual plans. So usually you may not be able to take the full deductions on them, but your SEP Simple Solo 401k, you can't necessarily open every single one of those accounts sponsored by your one company and make all of those contributions. If you are thinking about that, I'd highly suggest talking to a CPA because they'll probably tell you not to do that. Your other rules for contributions that have to be taken into effect for your individual accounts, like a traditional or a Roth, is for a traditional and a Roth, you must have earned income, meaning W-2, 1099. Can't always be passive income, such as if you own a rental property and are taking in monthly rent from that, that's typically considered passive income and thus could not be used to put into a IRA. Similar to if you personally have money invested in stocks, bonds, and mutual funds, that income that you make from those are considered passive. Important thing to note about Roth IRAs as well is they do have an income ceiling, meaning if you make over X amount of dollars on an annual base, whether it's individual or joint filings, you cannot make a contribution to a Roth IRA. There are ways to get around that I will get into in a little bit, typically called a backdoor conversion or backdoor contribution. And I'll touch on that in a little bit, but if you do hit those income ceilings, just note there is a way to get around them, but you cannot contribute directly to that Roth account, or else the IRS will penalize you and make you take the money out. For your HSA, this is the only account type that does not require having earned income. Passive income can be contributed to an HSA, but the IRS does have very strict stipulations as to who is eligible to contribute to those accounts. In terms of their health coverage, it must be a high deductible health plan. You cannot be on Medicare, so typically this rules out people over 65, and you cannot be considered dependent on someone else's tax filings. These rules are pretty well laid out within the IRS's guidelines, so if you do have questions in regards to whether or not your high deductible health plan is considered a high deductible health plan, you can always consult our website, the IRS's website, or oftentimes you can just call your insurance provider and ask them if it's a high deductible health plan and HSA eligible. They're pretty knowledgeable with HSAs. They deal with them quite frequently, so they can usually give you a yes or no answer pretty quickly. Your simple IRAs must be deferred from your salary and contributed by your employer. Simple IRAs usually have a matching percentage, typically no higher than 3%, that the company can match as well. So like New Direction has a simple IRA, I defer a certain percentage from my paycheck every month that they then put into my simple IRA, and they do their matching contributions throughout the year as well. The SEP IRAs are all deferred from company revenues, not necessarily from your salary, but they do have a maximum of 25% of those company revenues that must be taken into calculation when determining your contribution limits. So as I was discussing on the last slide, these SEP IRAs and 401ks are calculated a bit different. You may not be eligible to contribute the full $55,000 on an annual basis. So for the SEP IRA, the company's revenues, 25% of that is what is eligible to be contributed to the SEP IRA on an annual basis, with that absolute maximum of $55,000. If you're doing really, really well and your company is absolutely killing it, then you can absolutely make that entire contribution. But if you over contribute, then the IRS, and you don't pull it out, I should specify, within a certain timeline, the IRS can have some pretty stiff punishments for that. The solo 401k is a bit different from the SEP IRA, but still has a 25% limit for a portion of determining your contribution eligibility. So with a solo 401k, there is both employer and employee contributions. For the employee contribution, you can contribute up to 100% of your pay for that portion with a maximum of $18,500. And the remainder of it is the employer contribution limits. But the employer contribution only takes into effect 25% of your annual salary. So if you're not going to hit the remaining amount at 25%, you're only eligible to put in that 25% of your salary from the employer. But again, you can put as much of your own personal paycheck into it up to that $18,500 maximum. And I kind of have outlined this in the previous slide verbally, but just to give you a visual representation of who can make these contributions and who is in charge of necessarily running the account in a sense and who's putting cash into it. Made this nice little table for you. Traditional and Roth IRAs are purely individual contributions out of your own personal bank account. HSAs can actually be made by anyone. So say for instance, let's say your grandma wants to give you a present, you are HSA eligible, you don't necessarily want or need anything, but she thinks that this HSA is going to be a nice plan for you to get started with covering any medical expenses that you may incur in the coming years. So your grandma can actually help you open an HSA and make that contribution limit, or excuse me, that contribution on your behalf. It doesn't necessarily have to come out of your own personal income. The simple IRA is both a mix of employer and employee, as I'd mentioned. You defer from your paycheck, employer usually makes a matching contribution, whereas the SEP IRA is purely the employer making the contribution on your behalf. No salary deferral, purely from company revenue. And the 401k, again, is employer and employee contributions. Another good thing to note with these different account types is when you can make the contributions. When are your deadlines? Can you make them same calendar year, following calendar year, a year in advance? So for your individual accounts, the tax day of the following year is your deadline for making contributions to those accounts. Even if you do file an extension for your personal income taxes, that is not applicable for your contributions to a traditional or a Roth. So for 2018 contributions, we have up until April, I want to say it's 16th this coming year. It doesn't fall exactly on the 15th. April 16th of 2019, that you are still eligible to make traditional and Roth contributions. Same can be said for HSAs. These are also not applicable for extensions either. Your simple IRAs, since they are deferred from paychecks, is typically the last paycheck of the calendar year. There can be a little bit of a buffer into January for simple IRAs for the employer matching contribution, but for the contributions that are deferred from your paycheck, it is a hard stance of last paycheck of the calendar year. Your SEP IRAs and your solo 401ks can have different tax filing deadline, or excuse me, contribution deadlines, depending upon the tax filing of the entity that is sponsoring that SEP or that 401k. SEP IRAs are typically the tax filing deadline of the entity, including any extensions. So oftentimes we won't see contributions for SEP IRAs until sometimes even up to mid-October of the following year. It just depends on when that corporation needs to file their taxes, is when the contribution needs to be put into the account. And the 401k is a bit different as well. Typically kind of similar to the the simple IRA. Last paycheck of the calendar year is when the 401k contribution needs to be made. Justin, you sounded like you were gonna interject with a question.
No, I was just gonna add that about the SEP IRA, and how that you can still contribute all the way up with the extension. I had just heard that this year, and that was news to me. So I really appreciate you saying that, because I just found that out this year. So I imagine that's probably something new for a lot of folks to hear.
It can be, and this is probably more knowledge based than people need to know. But many institutions, including New Direction Trust Company, When we accept these contributions and deposit them, pretty much every other account type can be delegated to the tax year associated with that contribution, whereas SEP IRAs, because there's so much fluctuation in every entity's tax filing deadline, there actually is no tax year assigned to SEP IRA contributions, and it is up to the employer to show which year that contribution was intended for.
Oh, interesting.
Yep. Probably only interesting to a handful of people, but it's good information to know.
Yeah, absolutely. And it certainly helps if someone hasn't chosen one of these or is maybe starting a new entity and they want to find ways of contributing and maybe they want to open a new retirement account, along these lines. This is really some great information that they can then use to help decide which one they should be going with, and these are all the little nuances to consider.
Absolutely. And pro tip for those of you out there that are debating between different type of employer accounts, since that SEP IRA contribution limit is much further extended than a 401k, it's not uncommon that we don't see people open SEP IRAs just so that they can make contributions for the previous year and then actually move it into a 401k so that then they can utilize the 401k. It's kind of just the way around the deadline for the 401ks, should they not know exactly how much they are eligible for at the time that the 401k deadline hits, that they can still make that contribution for the previous year.
Oh, it's kind of interesting. So they open up a new account
All
or
right.
a different type,
So
and then oh, you there, Megan? Did we lose Megan or did we lose Justin? Did I lose everybody? Oh, let's jump back into that question section. Who can hear me? Can anybody hear Justin? You can only hear Justin. Uh-oh. Did we lose Megan?
those.
Oh, there you are. Megan, we lost you for a minute or two there.
Oh, I thought I lost you for a minute. Okay.
All right, can everybody hear both of us? Perfect. Okay, great. Megan,
Okay.
you're
All right.
back in it.
I'll rewind it for a second. I was just mentioning with the 401k, because it is both employer and employee, it technically has two different deadlines. The last paycheck of the calendar year, that deadline is for the employee portion of the contributions, the 100% of your salary, whereas the employer contributions, their deadline is actually up to the entity's tax filing date plus extensions as well. So those contributions will typically be made at different times, depending on when the company has the available cash and or resources to make all of the employer portions of the contributions. All right, to give you a full breakdown as to how these employer plans differ, we are going to kind of go through who runs them and what each role kind of means in a sense. So we'll start with our 401ks because they're usually the most different from a SEP or a simple or a traditional or a Roth. So a 401k actually has what is often referred to as a set of plan documents. And those plan documents are kind of your rule book as to what you can do with that 401k. They're highly customizable depending on what the employer wants. Typically, your larger sponsored company plans will be a bit more detailed into what you cannot do, whereas usually your self-directed 401ks are a bit more open to what you can do. So take, let's say, Boeing 401k, for instance. Boeing's a huge company, employs a lot of people. That's a lot of things to manage. So they're usually going to customize down their plan documents to not allow for self-directing, self-participant loans, which I'll get into a little bit later, even occasionally a Roth portion of a 401k, which again I'll hint on later, and what's commonly referred to as a in-service distribution. In-service distributions are just meaning whether or not you can move money out of that 401k into another type of account while you're still working for the company. If any of you out there are thinking that you have this 401k right now that you've been saving up for years that you want to roll over into a self-directed plan, but you're still working for the company, ask your employer if the 401k does allow for in-service distributions, because that's could either put a huge halt on your plans of moving the account or give you the green light to go ahead and get the process started. The other portion is with a 401k, there is a named trustee. Usually that trustee is the personnel decision maker in a sense. They're the ones that get to sign off on any investment documents like a purchase contract for a house, for instance, or say exactly what they want the 401k to invest in, assuming the plan documents allow it. The rules for a 401k are governed by both the plan documents and IRC, which is IRS code. So it has a mix of two different rules, typically outlined by the DOL in the terms of the plan documents and the IRS. And again, contribution is employee and employer. Whereas the SEPs and simples, and this can be applicable to traditionals and Roths as well, is where they differ is often in the type. There is no plan documents. The rules are strictly IRA rules outlined by the IRS. There is no named trustee. The trustee or the signer on behalf of that account, the one that legally executes any documents, is the custodian or the IRA provider. So for our SEPs, simples, traditionals, and Roths, New Direction actually executes any legal paperwork, including purchase contracts for real estate, to go back to that example. The rules are outlined strictly by the IRS in that IRC. Typically, it's IRC 4975, which is the part of the code that outlines prohibited transactions and disqualified persons, which are usually most applicable to self-directed investors. And your contributions are a mix depending on what type of account you're talking about, but we've covered that enough, so I won't go into that in any further detail. So ultimately, rules can be a bit different depending on what type of account it is, and signing authority, decision-making capabilities can be a little bit different in terms of who gets the final yay or nay. Nope, sorry, I missed those ones. And I've kind of touched on this in the previous slide, but it is important to reiterate for you guys that self-directed 401ks can be a bit different than your standard 401k like Boeing would offer. Not all of those plan documents will allow for alternative investing or to hold alternative assets. Typically, larger company-sponsored plans are held at the brokerage firms of the company's choosing because it's easier to manage, the record keeping is a lot simpler, as well as the cost of maintaining that large of a 401k is going to be a lot more manageable for the company at that point in time to go with a brokerage firm versus allowing everyone to self-direct. Self-directing is a bit of a niche marketplace. That's the reason the fees can be a little bit higher than with your Vanguard or Fidelity, but they are typically calculated very differently. They're not necessarily commission-based or percentages. They're laid out a bit differently depending upon the firm that you choose to hold that self-directed 401k and or IRA. I will say with our 401ks, our plan documents that we do provide are built out to be as flexible as humanly possible. Basically, you can make a few decisions about whether or not you want self-participant loans, a Roth component to that 401k, but ultimately we build them to be capable of doing anything. It's just your decision whether or not you want it to be allowed. For a self-directed IRA, there are brokerage firms out in the world that will say it's a self-directed account, but it typically isn't. It's usually still a mix of stock sponsor mutual funds of their offering, and they just allow you to select from those handful of things, versus a truly self-directed account that lets you hold pretty much anything that you want to invest in, including real estate, private money lending, precious metals, et cetera, et cetera. So if you do hear your typical brokerage firm say that they do self-directed IRAs, second guess them, question them, particularly if you have a particular asset class in mind. All right, some of these cool 401k features, and this is probably one of the more exciting slides that I would say to take notes on, because this ultimately is going to help you decide whether or not you feel that a 401k could be more applicable than a SEP or a simple. And it oftentimes can depend on your investment strategy. So 401ks do have what's called a loan provision, or what I've been referring to it as is a self-participant loan, meaning that the 401k can actually loan money to the account holder, or the trustee, or one of the employees that are under that 401k. There are specific rules on it that it's $50,000 or 50% of the account value, whichever is the lesser amount, has to be repaid within 5 years if it's used for anything besides a first-time home purchase. There is interest and principal, obviously principal, but interest has to be competitive rate in the marketplace, and all must go back into the 401k. There can be penalties, tax consequences if it's not repaid back in that timeline. The other cool portion of a 401k that some people elect not to always use, but some people do because it is a great feature to have, is that a 401k can actually have a Roth component, meaning within that one 401k, you can have both pre-tax and post-tax money. You can split the contributions, usually how you see fit. It is typically a guideline that the IRS has that they only want you to put your employee or that $18,500 on an annual basis into the Roth portion of the 401k, and usually for record keeping purposes, you'll want to keep them separate so that any growth can be directed towards the right tax status. But it is a good way for you to be able to, in a sense, diversify and continue to grow your retirement funds in two separate ways, both tax deferred and tax free when it comes out. And I'll be kind of brief and go into this one a little bit, but if you have additional questions about this UDFI option, then please contact us. This is a fairly in-depth portion of the knowledge base that does need to be known about for our real estate investors that do obtain what's often called a non-recourse loan in order to go purchase a property. When an IRA takes out a loan and goes and buys a property, it can create a specific type of tax called UDFI, stands for unrelated debt financed income. This would be applicable for every other account type except for 401ks. I wish I could give you a solidified reason as to why this type of tax is not applicable to 401ks where it is for IRAs and HSAs. But the 401k could go out and obtain a non-recourse loan, go buy a property, and not have to worry about this UDFI. It's a tax consequence that all IRAs would need to file and potentially pay for on an annual basis. Doesn't affect your personal income, or excuse me, your personal tax filings in the least bit. It's purely stuck to the IRA, but it's not something you have to worry about for a 401k, which is oftentimes a huge winner of why people will choose a 401k over one of the other account types should you be eligible for a 401k.
And so Megan,
yes.
what's the difference between UDFI and UBIT?
Technically, same thing. UBIT,
Gotcha.
unrelated business income tax, is the actual tax's name. UDFI is one of the branches of it that can cause that UBIT tax. So UBIT is broken down to unrelated debt financed income and unrelated business taxable income. So UDFI is one of the things that spurs UBIT.
Gotcha. Perfect. Thank you.
No problem. Another thing that a 401k can do that an S Corp cannot, that an IRA cannot, is that it can invest in an S Corp. Typically, I want to say this is due to liability reasons as to why an IRA usually cannot and 401k cannot. But the majority of what I can tell you is that it's an IRS stipulation. I will also take this second to hit on one specific point that I haven't quite focused on at this moment. There is two types of 401ks that are commonly seen. There's a larger company sponsored 401k that covers many different employees, or there's the type of 401k that New Direction Trust Company handles, which is oftentimes called a solo 401k. And these are meant for self-employed individuals. So you run your own business, you don't have any full-time employees. This would make you eligible for a solo 401k. If you were to have employees, full-time employees, then you would have to go with a larger company 401k or SEP or simple IRA. Well, this is one of the cool parts that I really wanted to touch on when we first started discussing this webinar, because this is a relatively new rule in the last couple years that the IRS just stipulated, that you can now do in-plan Roth conversions, meaning should you decide to start that 401k and put all of the money in the pre-tax portion of the 401k, nothing in the Roth component, you can actually, while you're still working for the company and making contributions, convert some of that cash over to the Roth component so that you have both a mix of pre and post-tax money in there at that point, even though you didn't contribute it initially to the Roth component directly. Any amount that you do decide to convert over to that Roth would be considered income for you for the year and taxed at whatever income tax bracket you fall into. And there are new rules set in place about the Roth component. Roth component or Roth distributions can be very different than traditional distributions. Typically, with Roth distributions, you can take out the amount that you've contributed before you turn 59 and a half without any taxes or penalties. It's only once you start hitting the growth from your investments, if you distribute that before you're 59 and a half with a Roth, then you're looking at that 10% penalty. But for that distribution to be considered not an early distribution, the account does have to be in place for at least 5 years. So with these in-plan Roth conversions, that 5-year holding period is still applicable. So say, for instance, I have my 401k that I've got all sitting in pre-tax money. I convert some of it to a Roth component, pay the taxes on it, but then I have to wait until 5 years from now until I can take any of that cash out without dealing with the 10% penalty, assuming it is considered part of your contributions. After 59 and a half, and if that account has been in place for 5 years, then you can take it out at any point in any increments. But every time you do one of these in-plan conversions, that 5-year holding period restarts. So that can pose an issue for some if they're looking at maybe trying to get at some of the Roth component before they turn 59 and a half. If that's not your main concern as to why you're doing the conversion, then you have nothing to worry about. But it's also important to note that this is not reversible. If you do this in-plan conversion and you decide, darn, I had a better year than I anticipated, I'm going to be in a higher tax bracket, it's not a good year to do this, you can't do an undo. You can't take it back and put it back into the pre-tax component in order to avoid that tax bill. Once it's done, it's done. Another thing to note about the 401k Roth component that differs from a Roth IRA is that after 70 and a half, the Roth component is also still subject to RMDs or required minimum distributions. A Roth IRA, because you've already paid tax on it when you first put the cash in, is not subject to RMDs. So that is one important note to differentiate between a Roth 401k and a Roth IRA. But it again is at that 70 and a half age that this becomes important. With all of your pre-tax accounts, you're going to have to start taking those distributions at 70 and a half. Roth IRAs is the only ones that you do not. All right, I'm going to switch over to the IRA component now. If there's any questions, please feel free to put them in about the employer accounts now before we switch subjects.
Well, I don't see any questions. Oh, here we go. We got one. Until when in the year do you have to do the conversion?
Let's see. You can do it at any point in the year. It just depends on which tax year you want that tax bill in. So typically it's up till it's up in the calendar year. No, excuse me. Did we think that one? I want to say it's until the tax filing deadline of April 15th to make that conversion for it to be considered the tax year.
Perfect. Thank you. I think that's all we got for right now.
All right.
Let's find out why we should have an IRA.
All right. For those of you that already have a company-sponsored plan, aren't eligible for like a solo 401k, or aren't self-employed and can't sponsor your own plan, IRAs are also a good option for you. Their lower contribution limits can set a few people back, but oftentimes if you've got old 401ks out in the world from companies that you used to work for, you can consolidate them into one IRA. Choosing between the two different types of IRAs, a traditional or a Roth, can often be a huge question that people approach me about as well. Which one's better? Which one should I choose? It's hard for me to say because I don't know your full financial statuses, what tax bracket you're in, how much income you make on an annual basis. It's a good question to ask your CPA, but it does often depend on whether or not you have all pre-tax accounts out in the world that you're trying to consolidate. If you want to do a conversion and take on the tax burden or that taxable bill come the end of the year. But the differences between the accounts, that pre versus post tax, I've kind of already hit on. And the whole reason to put them into an IRA instead of just keep it in your own personal pocket and make those investments personally is that essentially you are helping yourself avoid tax at that particular time, including capital gains tax for our real estate investors. So the difference between the pre and post tax and determining which one is appropriate is often a speculation game and figuring out whether or not you think you are at a higher tax bracket now or will be later. Oftentimes people choose pre-tax accounts like your traditional IRA because the idea of those account types is that while you're working and contributing to those accounts, you're going to be in a higher tax bracket than when you retire and decide to take the money out. But some people don't really want to play that speculation game. We don't know what the government's going to do, how they're going to change tax brackets. So some people will just eliminate that speculation at all and go with a Roth IRA so that you're taxed now and don't have to worry about required minimum distributions or where the tax brackets may fall once you're at retirement age. So they both have a bit of pros and cons. No one likes having the IRS tell them what to do. Lord knows I don't. I would be shocked and surprised if anyone out there did say that they like the IRS telling them what to do. But both can have their benefits, and the nice thing is, like that Roth component of the 401k, you can do a traditional to a Roth conversion, and I will touch on that now. This also is a taxable event, so the amount that you choose to convert to that Roth IRA is going to be considered income for you for the year. There won't be a 10% penalty on any conversions because it's technically not leaving a tax advantaged account and going into your own personal pocket. And the IRS has changed some of these rules also recently. It used to be that you could only convert a certain amount, but now it is no longer subject to those contribution limits or a stipulation on how much amount you can convert at a time. You can convert, 2,000, you can convert 50,000, you can convert $500,000, $1 million, you can convert however much you want at any time. You just have to keep in mind that is going to be a taxable movement for you. I also touched on that 5-year rule previously, so I won't go too far into that one at this moment, but should you do this conversion, that 5-year rule starts and you can't take distributions until those first 5 years are up. One new rule that they did have most recently, this was actually changed this year, is that once it's converted, it typically can't be undone. The only amount that can be moved back into a pre-taxed account is your contributions. So say you have 100,000 that you move from a traditional to a Roth, but only 50,000 of that was amounts that you had contributed to the account out of your own pocket. The other 50,000 was growth from your investments. Should you move it over, have a great year and decide that that's too much taxable income for you to take on at that moment, you can recharacterize into the traditional IRA that 50,000 that was your contributions. The other 50,000 has to stay in the Roth IRA. It cannot be moved back and undone. Why do people do this? It's a lot of what you would think. Again, on your total tax analysis, you had a not so great year with a lot of credits or losses, and you want to eliminate the possibility for required minimum distributions. So it seems like a good year to take on that taxable offense and move some of the cash over to a Roth. Those are some of the common reasons, as well as we saw a lot of these oddly right before Trump's initiation and his rollout of the new tax plans, even though he was questionable on having lower tax brackets depending on which range you fell into. But some people will do these before a change in presidency with concerns over rising tax rates. But common other reasons is it's a generational wealth strategy. So say for instance, I had $1 million in my Roth IRA. I didn't ever have to take required minimum distributions on them. So I've named my beneficiaries to that Roth IRA to inherit it upon my unfortunate demise. They will inherit that Roth IRA as an inherited IRA, but because it was originally a Roth IRA, when they have to start taking money out of it, or should they elect to take it all at one time, they don't have to pay taxes on that. Whereas a traditional IRA, you have to take the required minimum distributions, and should it move on to beneficiaries later on in life, when they take it out, they are also taxed on it. We also see a lot of people make this decision to do the conversion when they have an investment that they know is going to be huge. Say for instance, let's call it Amazon. Say a million years ago, I decided to invest in Amazon before it became publicly traded, and you knew it was going to be a huge thing. So I decided to convert some of my cash and invest in some private Amazon stock at that time because I knew that the gains I was going to have on it were going to be exponential. So because I invested with the Roth IRA, the returns come back, and when I decide to take cash out, it's going to be tax-free. So make it that $5,000 investment. It's going to have a $5 million return and not have to pay taxes on any of it. There's also this backdoor conversion strategy for those of you that make a little too much money to be able to contribute directly to a Roth on an annual basis. You can contribute directly to a traditional and then do this conversion of that contribution into a Roth so that you're still putting money into that post-tax status, but because you aren't eligible to do it directly, this is just the way to get around that rule.
And so how often can you do that backdoor conversion? Is that something potentially you could do every year?
Yep, you're still subject to the contribution limits of that 55 or 6,500, but you can make your contribution on an annual basis and convert it immediately. You can do it next day, same day as it's deposited, however frequently you want.
Gotcha.
All right. So I've mentioned this multiple times through this presentation of how do you know which account is right for you? And oftentimes it's dependent on what type of account you already have. So right here is our rollover charts that stipulates what type of accounts can move into what other type of accounts and whether or not it's going to potentially be taxable, if they must be maintained separately, whether it would be considered a transfer or a rollover, meaning whether you initiate it as the account holder or whether you have the new company, New Direction Trust Company, whoever it may be, start the process for you. They can be a little bit different in how they move as well as, as they're reporting with those movements. But your like-kind accounts, so typically Roth, SEP, Simples, 401ks, at least the pre-tax components, those can all be combined and consolidated into one account. But moving any of those pre-tax accounts into a Roth IRA, usually can't do, at least not without paying tax on it. And the other weird thing to note, if the 401k did interest you, is if you elect to have a Roth component, you actually cannot move a Roth IRA into a Roth component of a 401k, but the Roth component of the 401k can move into a Roth IRA. I think it's a silly rule, but that's just my take. Who knows why the government does what they do. If you do have any questions on this or want to examine it a bit more thoroughly, this is also on our website. It's an IRS publication as well, pretty easy to find. So you are more than welcome to dive into it should you feel the need to get a headache from all of the grids. Now, the most important question. You have this self-directed IRA or 401k, and you want to invest in real estate. How do you do that? There are a couple different ways, depending on your strategy, whether you want to get into real estate directly and be, in a sense, a landlord. If you want to have more of a passive investment that is still involved in real estate, there are a couple different ways. So our most common is direct ownership, meaning that the IRA actually owns the property, rental income flows in and out of the account. You can obtain leverage in the form of that non-recourse loan that I had mentioned earlier in order to purchase the property should you not have 100% of the available cash in the account, but you want to be the only owner. Another option would be to have the IRA actually partner with any other person, any other IRA, any other 401k, any other corporation. As long as it's done from the beginning of the investment, usually the account can take on any partners that it wants. Each partner would be assigned a percentage of ownership at that point, and cash flow, both income and expenses, would be split according to those percentages. This one can be a bit more of a hands-on investment structure in comparison to some of the others, because you can be thought of as a landlord. You're the big decision maker in terms of who lives in that property, who works on that property, whether any renovations need to be done. So you still get to be really involved with that property in general. But for those of us in the Denver metro area, we know what kind of rent charges you can make. They can be pretty extensive. And I say that as a very happy renter, my apologies. But you can make a good amount of cash, assuming it's a good property in a viable neighborhood, because there are areas out there that are either up and coming, you can capture the appreciation upon sale, or have a good monthly income with that rent. Our other option is private equity. So this is for more of our hands-off or passive investors that want to invest in a private company that then goes and takes the cash and does commercial real estate or hard money loans with it, like Pine Financial does. There's a lot of different ways that companies operate with different types of real estate, but you still don't have to necessarily be involved in on day in, day out basis. You invest with them, they do what they want with the cash, assuming they do well, which hopefully they do. They'll continue returning dividends until the conclusion of the investment. Another option that we see as well, should you not necessarily want to put your money in someone else's hands that you don't have quite as much visibility into, is private lending. An IRA can actually make loans out to other individuals, corporations, IRAs even. There are a few stipulations about who you can and cannot loan to, but I won't necessarily get into all that detail because I'm already running a little bit behind. Sorry guys, I talked too much. But you can have these secured by a piece of real estate or whatever other collateral that you and the borrower agree to. And that's the conclusion of my presentation for today. On the screen is all of our contact information. If you call the 877 number and dial into extension 155, you'll reach myself and my department, or you can email us at info@ndtco.com. If you have additional questions, our website is chock full of really great information and is actually pretty easy to navigate. So it's also a great place to start. There's guides that you can download and or other webinars that you can watch on a multitude of different subjects. At this point, Justin, if there's any questions, I'd be happy to answer them now.
Yes, we got a few here. So can an IRA be used to invest in tax liens?
It can. Yep. The IRA is treated as a separate financial and legal entity for any investment structure, thus it has its own naming convention and tax ID. It would never be involved with your personal name or your social security number. So we see a lot of tax liens and lien investors.
Perfect. Here's one. Yes, she said you can, Deborah. You can invest in tax liens. So Steve says he has a self-directed Roth IRA that he uses for fix and flips, but he's interested in converting it to his solo Roth 401k. And it looks like publication, IRS publication 590, says that this is prohibited, at least directly. So is there some sort of workaround for that?
Nope, unfortunately not. To kind of move back to our rollover chart previously, that Roth IRA to a designated Roth account of a 401k is a solid no. It unfortunately can't be recharacterized anymore because of IRS regulations, so there really is no good way to get the Roth IRA into the Roth 401k.
Gotcha. All right. Sorry, Steve. Robert says, are hard money loans at Pine Financial non-recourse loans? So no, our everyday loans are not. non-recourse, they are full recourse. So like our rehab loan and our acquisition loan, these are recourse loans, but we do have a loan that we designed for IRAs, and that one is non-recourse. So if your IRA is interested in getting a hard money loan to say do a fix and flip or something like that, we can certainly chat more. It's very, very similar to the rehab loan. I think one of the basic things is it's a lower loan to value, since it does have to be non-recourse, and we do want to make sure that the IRA has more reserves, more liquidity. So those are probably the two big differences. But yes, if your IRA wants to do a fix and flip or borrow hard money, we do have a loan that might work for you. All right, anything else? Oh, here's one. I have funds in a Roth TSP. Is there any penalty if I convert those funds into a Roth IRA outside of the TSP account? Are these funds counted as additional income if they are already post-tax?
They would not be. So a TSP stands for Thrift Savings Account, and they are very similar to a 401k. So moving it from that Roth component of your TSP to a Roth IRA would not have any tax consequences. It still stays in the same tax status.
Perfect. All right, anybody else have any questions?
And I'll jump back for just a quick second to the non-recourse loan. I will say the name can be a little bit misleading. There is still recourse with a non-recourse loan for the lender. The big difference is with a non-recourse loan, there is no personal guarantee by the account holder. So should the IRA in this instance default on the loan, the only recourse that the lender has is taking that property that the loan is secured by. They can't go after your own personal holdings, your own personal money, your own personal residence in these scenarios. That's an IRS stipulation that you can't guarantee anything for your IRA, nor can you put your IRA up as collateral for anything that you decide to purchase personally.
Perfect. Appreciate that. A lot of times people don't necessarily fully understand what that means. So,
Yeah.
so does your company provide tax planning services for out-of-state clients?
We do
Um,
not, oh, sorry, go ahead.
no, go ahead. Go ahead.
I was just going to say, we don't provide tax planning services whatsoever because we legally are not allowed to. We are not considered a fiduciary, thus we can't provide tax, legal, any type of investment advice to our clients. So oftentimes people have their own CPA that they will work with in order to do so. I will say we also have a sister company. One of our co-founders is a CPA. So the sister company usually assists people occasionally with tax planning, sometimes with tax filings for 401ks or those UBIT filings that we were discussing previously. I'd be happy to follow up with their contact information if this individual wants to email us at info@ndtco.com, or you can Google them. Their name is IRA Tax Services. They have their own website.
Perfect. All right. Anybody else? Last minute questions? Yes, I have a friend that would like to move into a self-directed. Is there a way to roll over a part company 401 while still employed by the company?
They need to ask their employer. Um, Usually, I would say 80% of the time, the answer is going to be no. But if they are over 59 and a half, they usually can move out a portion of their account. They won't be able to move all of it though. So they should really go talk to their employer about it and see if they're eligible for in-service distributions.
Great. All right. Well, maybe there's going to be one more question. Let's see. And I don't see anything else. Well, Megan, thank you so much for coming and hanging out with us tonight, sharing this awesome information. Selfishly, this was something I have been wanting to know for quite a while, and you did a great job of explaining it, working through it, and obviously other people were receptive to it as well, since we had a bunch of questions. So really appreciate your time. And again, if you need anything from Megan, her contact info is on the screen right now. If you're interested in a hard money loan or If you have an IRA or something like that that's looking to maybe make some money through lending against real estate, and you're interested in what that might look like with Pine Financial, please reach out to me. My email is justin@pinefinancialgroup.com. Our phone number here is 303-835-4445. And one last time, if you're in Minnesota and free this weekend, please stop by and check us out at the Minnesota Real Estate Investor Success Summit, and you can do that at mniss.com. Megan, thanks again for coming out tonight, and we will talk to you soon.
Thanks, Justin. Thanks for everyone for attending.